Hey, this is Matt, co-founder of Universal CPA Review, the #1 CPA review course for visual learners. So thanks for checking out this video where we're going to walk through the lecture on investments for equity securities, very important topic for the CPA exam. But before we get started, please subscribe to our YouTube channel. It makes a huge difference. You can also join our Facebook groups or our Reddit community or start a free trial. The links are in the description of this video. So let's get after it. Let's get excited and let's take a deep breath and go attack this module. This module is going to be all about investments in equity securities. Now, this is separate from debt securities because we're talking about equity. And maybe you don't know what an equity security is yet, but by the end of this module, you will know how. So here's our mental map for marketable equity securities. These are something that the company would buy as an investment. So we've laid out in this mental map the 4 steps or the 4 key aspects of marketable equity securities that we need to nail down for the exam so that we're ready for any type of multiple choice question or simulation that the AICPA might throw at us. So our first step is we need to be able to identify what a marketable equity security is. There's really going to be 4 main types, and we'll get to them shortly, but basically it's common and preferred stock, and then options and warrants. You're going to read through a question and they're going to say one of these different types of equity securities, and then you'll have to know what method to apply, right? And we'll get to that method here shortly, but the first things first, we need to understand what is a marketable equity security, because they can also give you a marketable debt security and the treatment will be different, right? So it's very important that we understand the main types of marketable equity securities that we'll see on the exam. Now, with marketable equity securities, there could be a few different options for valuing them on the balance sheet and reporting them in the financial statements. In this module, we're going to talk about applying the fair value or cost method, which basically means that as long as the company does not have significant influence or significant ownership, which is generally thought to be of around 20% of the outstanding stock of the company, then they can account for this investment on their balance sheet using fair value. And we've talked about fair value before, but fair value, it has different levels, right? Level 1, which is the most common, would be I bought or the company bought shares of Apple or Google, right? And we can look up the fair value of those investments at any point, at any date, using something like Bloomberg or Yahoo Finance, and that will tell us what the actively traded market price is for those securities. Now, some other securities might be a little bit more difficult, but the goal really in this module is that we need to understand that we're going to value equity securities at fair value, right? Assuming significant influence doesn't exist, because if it does, or they say they own more than 20%, up to 50%, it would be the equity method, which we'll talk about in subsequent modules. And then if they own more than 50%, that means that they're going to need to consolidate that company into the parent financial statements, right? So we have to understand how marketable equity securities fits into the overall big picture of securities that a company could own. And in this specific module, we're going to talk about where they just, decided to buy a couple of shares or a few thousand shares, nothing significant. So these first 2 steps are critical, right? We need to understand what type of security they're talking about, and then assuming that it's a marketable equity security, we need to figure out, okay, are they going to use the fair value or the cost method, or are they using the equity method, which again will be talked about in another module. So then we're to step 3. Once we've determined that the fair value method is going to be used, we need to understand the classification in the financial statements. Well, it's easy to remember. All unrealized gains or losses, or realized gains and losses, those are going to hit net income in the income statement. And then on the balance sheet, the investment, it'll be classified as either current or non-current, depending on how long the company plans to hold the marketable equity security. And then lastly, in the statement of cash flows, well, this coincides a little bit with whether it's current or non-current. If it's current, meaning they're going to sell it in the near term, then they would classify it as operating. But if they plan to hold it for a longer period of time, as it sounds, right, that's more of an investment. So it's really up to the company to determine whether they want to put it in the operating section or the investing section, but just know that it can go in either one. So most of the questions on your exam, they're going to focus on how to classify different activity in the financial statements and how to do the actual calculation of unrealized gains and losses. So we'll get to that. We'll go through an example. But real quick, step 4, the recognition of dividends, right? So as a security holder, right, whether it's common or preferred stock, you as the shareholder could be entitled to dividends. And these could be non-liquidating or liquidating. So non-liquidating would just be an ordinary cash dividend that's paid out of profits. That's usually good. The company means, they have excess cash to distribute to shareholders. If it's a liquidating dividend, well, it could be bad. It could also be good. But basically, this means that they're selling off part of the company. They're liquidating the assets, right? And the treatment is different between these two types of dividends. So we'll go through an example there as well. So that's our mental map for this topic. Overall, I don't think you'll find this topic to be too difficult. From a conceptual perspective, some of the calculations that you'll see in multiple choice questions, we have to pay close attention to the dates, but again, we'll get to those. There'll be videos on those to show you exactly how to work through them. As I previously mentioned, step 1 is being able to identify a marketable equity security. So there's 4 types that we need to be on the lookout for. And it's important because you'll read a question and you need to go, oh, that is a marketable equity security. It's not a debt security, because you will see questions with debt securities and we need to know the difference. So the 4 main types of marketable equity securities are going to be common and preferred stock. Those are going to be the 2 main ones. And then you could also see something about options, which consists of calls and puts, and then stock warrants. It's less likely to see a question about options and stock warrants that relates back to how to calculate the unrealized gain or loss, mainly because the exam is no longer saying you need to do all those calculations, because trust me, those are very difficult. So most questions, and you'll see these when you practice the multiple choice questions in this module, they relate back to common and preferred stock. It will say something like XYZ company purchased 5,000 shares of common stock in ABC company, right? So as straightforward as that, and you'll go, that's a marketable equity security. Now I know we need to move to step 2. So in step 2, this is where we need to figure out whether we're going to use the fair value method or some other method to account for this equity investment. So as I mentioned, here is a key visual that will help you understand at a high level whether to use the fair value method or the equity method or the consolidation or acquisition method. And we'll touch on the equity method and acquisition method in later modules, but broadly, if a company buys less than 20% of another company, they're not going to have what's considered to be significant power over the operational or financial decisions of the business. If they have more than 20%, it's more likely that they will. Now, they can have less than 20% and still have significant influence, right? They could have board seats. The question will usually indicate whether significant influence exists. So if you see something that has a question that says they bought 5% of the outstanding common stock, they don't have significant influence, then you know to use the fair value method. And it's just as it sounds. When we originally buy these equity securities, they're at our cost, right? How much did we pay for them? That would also be assumed to be the fair value. And then at any reporting date or when we sell them, well, it would be the fair value again. So what happens if basically we can't value this equity security at fair value because it's difficult to do? Well, there's other methods of what we can use. This is broadly referred to as the practicability exception. Sorry if I struggled, but that's a difficult word to say. But essentially, we would just carry it at cost on the balance sheet and then assess it for impairment or other issues that could either increase or decrease the value of the security, right? But the main point overall is that we're going to value it at fair value, and that's what a lot of this module is going to really focus on, and a lot of the questions related to it will focus on, okay, here's the fair value. Do you know how to record the journal entries and stuff like that? So once we're comfortable with steps 1 and 2, meaning we've identified that it's a marketable equity security and that we're going to use the fair value or cost method for this investment, then we need to determine how to classify it in the financial statements. And this could consist of the income statement, the balance sheet, and the statement of cash flows. A majority of the questions are going to relate back to the income statement. So here is a great visual that helps you remember that equity securities, well, first off, they're always going to be classified as trading. Now, if you remember from the debt security lecture, they could be classified as trading, available for sale, or held to maturity. But for equity securities, they're always going to be trading. They're always going to be valued at fair market value, and then unrealized gains and losses, as well as realized gains and losses, those are going to the income statement. They'll either increase or decrease net income, right? So very easy to remember. There will be no impact to other comprehensive income if it's a marketable equity security. And then when it comes to the balance sheet, it can be reported as either a current asset or a non-current asset. It really depends on the company's intent to hold or sell this thing, right? If they buy it and they have the intent to sell within 6 months, that would be pretty short term, and they would likely classify this as a current investment. But if they plan to hold for 2, 3, 4 years, that's going to be more long-term or non-current, right? So most of the questions, they'll either indicate what the company's plan is for this investment, but use that information to basically assess whether it's going to be current or non-current on the balance sheet. So when it comes to the statement of cash flows, it really is at the discretion of the company. It's all about their intent to hold or sell, similar to the balance sheet, right? If they plan to sell it in the short term, after they buy it, well, that's going to be current on the balance sheet, and it would be in the operating section of our statement of cash flows. But if they plan to actually hold it for a long time, it's more of an investment, so it makes sense to put it in the investing section. So again, you're going to have to look for clues to determine whether it's operating or investing, but just know that the company, under US GAAP, they can choose either part of the cash flow statement. Now we're going to talk about how to deal with liquidating and non-liquidating dividends. As a holder of common or preferred stock, if the company declares a dividend, well, you're going to be entitled to that dividend. Now again, when you see dividends in a question, the default type of dividend that you're going to assume is going to be non-liquidating, meaning the company declared a dividend of, say, $5, and it's in cash and it'll be paid out, right? That's the default assumption. But they could also issue a liquidating dividend, which means they're liquidating either part of the company or all of the company, and that is when they're returning capital to shareholders. It's not being paid out of retained earnings like a non-liquidating dividend would be. And it's really important that we understand the difference between these two because they impact the financial statements differently. So as you can see in this visual, well, a non-liquidating dividend, that gets recorded to dividend income, which is going to increase net income in the income statement. If it's a liquidating dividend, it's going to impact the investment account on the balance sheet, and it's actually going to decrease that investment, right? If they issue a liquidating dividend, that means they're decreasing the value of the company and returning capital to shareholders. That's going to decrease our investment on the balance sheet. Let's take a look at the journal entries for both a non-liquidating dividend and a liquidating dividend so we can see the differences here. So on the left side is a non-liquidating dividend. Let's say it's $25,000 of cash. Well, we're receiving cash, so we would debit cash for $25,000, and then we would credit dividend income, which is similar to a gain. It would probably be considered non-operating in our income statement, but that would be a credit for $25,000. And like I said, that's going to increase net income. Now on the right side for a liquidating dividend, we can see that again, if it's $25,000 of cash, we would debit cash for $25,000, but the credit is to a balance sheet account, and that's going to reduce our investment in XYZ, right? It decreases the asset on the balance sheet. So in that case, there is no income statement impact for a liquidating dividend. So when we think about how dividends impact the income statement, well, first off, it needs to be non-liquidating dividend, but it's going to be reported separately from any change in fair value, right? So if we have an unrealized gain or loss on an equity investment, that's reported separately from a dividend. So a lot of questions will ask about what's the unrealized gain or loss. They'll also throw in some information about a dividend. We need to know that those two are separate from each other, right? So we'll go through another example of a dividend here shortly, but very important to understand the two different types. So now that we've gone through the 4 steps of our mental map for equity securities, let's take a look at an example. So as the example starts off, it says that Eagle Company purchased 10,000 shares of common stock in Bear Company for $105,000 on January 1st, year 2. Right? So pretty basic. They purchased common stock, so we know that's a marketable equity security. Now the question also states that it represents 4% of the outstanding common stock of Bear. Right? So it's not necessarily significant here. So we'll go ahead and use the fair value or cost method to determine how to treat this investment in the financial statements. The next sentence states that we are to assume Eagle received a $12,000 non-liquidating cash dividend from the investment in Bear during year 2. So non-liquidating, we know that's basically just a normal cash dividend, and that's going to increase our net income. So we'll look at that here in a second. And then it says by December 31st, year 2, the investment in Bear had increased in fair value by $6,000. Right? So again, at the end of the reporting period, we assign a fair value to it. In this case, it increased $6,000. And then on February 15th, year 3, Eagle determined that it's time to sell this investment, and they sold it to the general market for $120,000. So a lot of information there. We're going to go through and prepare the journal entries for each step of this investment, and it all relates back to the different aspects that we already talked about. So let's start with the journal entry they would record for the initial purchase on January 1st of year 2. They simply bought 10,000 shares of common stock for $105,000 of cash. So we're going to debit equity investment in Bear Company for $105,000 and then credit cash for $105,000. Right? We don't know necessarily whether it's going to be current or non-current on the balance sheet. We'll leave that up to Eagle Company. And again, we don't know whether it's going to be in the operating and investing section. It really depends on their plans. So now let's look at the journal entry to record that non-liquidating dividend of $12,000 that they received during year 2. Well, recall our visual, right? Remember, it's just going to be dividend income, right? It's not going to impact the carrying value of the investment on the balance sheet. So that $12,000 cash, well, we're getting that. So it's a debit to cash for $12,000, and then we would credit dividend income for $12,000. So that's going to increase net income for year 2 based on this receipt of this non-liquidating cash dividend. So fairly straightforward there. Now we're going to look at the journal entry they would record for the change in fair market value by the end of December 31st, year 2, right? It says it increased $6,000, and that is great to know. So since there's an increase in the investment, well, we'll debit the equity investment in Bear Company account on the balance sheet to increase that amount to the fair value. So now it's up to, say, $111,000. Now we're also going to record a credit to the unrealized gain on this equity investment for $6,000 as well. Right? That's going to hit net income in the income statement. Even though it's unrealized, it's still going into the income statement because we're using the fair value through net income method. So moving forward to February 15th of year 3, Eagle says, okay, let's dump this thing. Let's sell it. Right? So they sell all 10,000 shares of common stock for $120,000. Now remember, at December 31st, year 2, the fair value was $111,000. So they're going to make some money on this, right? They're going to recognize a realized gain on this investment in year 3 of $9,000. Right, so when we look at the journal entry, well, we have a debit to cash for $120,000, and then we would credit equity investment in Bear for $111,000, which is coming from basically what would have been the balance at December 31st, year two. And then we'll also recognize that realized gain on the equity investment. And you're saying, well, wait a second. They initially purchased it for $105,000. Well, yes, but that $6,000 that was unrealized, that's already in the income statement. So if we included it again, we'd be double counting it. So we only need to take the difference from what the balance would have been at December 31st, year two, which was $111,000. So make sure you understand, and this is very important, that for each reporting period, we will value it at fair value and report or record the unrealized gain or loss. And then in the year that it's sold, when we can realize a gain or loss, it's only going to be the change from that most recent balance sheet period. So very important to understand. One last thing to wrap up this module on marketable equity securities is how should we disclose basically unrealized gains and losses in our financial statements related to these equity investments? Well, obviously, the accounting standards codification, right? It does require us to disclose the unrealized gains and losses. Here's an example that comes directly from the codification. It basically says that we need to show what the net gains and losses recognized during the period on equity securities were, right? So for example, $10,000, we would subtract the net gains and losses recognized during the period on equity securities sold during the period. Again, a bit wordy, but let's say it's $5,000. Then we'd be left with unrealized gains and losses recognized during the reporting period on equity securities still held at the reporting date, right? So we're still holding these equity securities. We've recognized some unrealized gains and losses in our income statement, and this is all we really need to disclose, right? Basically, financial statement readers, they want to know that if we're still holding some of these investments, have they increased or decreased in fair value on an unrealized basis, right? So that wraps up our module on marketable equity securities. Again, remember the four-step mental map. The key things were being able to identify a marketable equity security, how we go ahead and report this on the balance sheet and the financial statements, right? It's at fair value. And then how unrealized gains and losses are recorded directly to the income statement, the classification on the balance sheet and cash flow statement, and then lastly, how we will treat the two different types of dividends, which would be liquidating and non-liquidating. So review the study guide. This is a very short module in terms of a lecture, but it's very pinpointed. Now go practice those multiple choice questions and simulations.